Good day, fellow investors. YouTube tells me these are the videos you are most interested in, and that is what are the big boys buying. You probably already got the information about the superficial whys, but in this video, as always, what you expect is to go into the risk and reward of the interesting stocks there to see whether those are buys just for the big boys, there is a big difference, or also for your portfolio. So let's immediately start with Warren Buffett. I've just recently discussed Berkshire. For me, at these levels, just because of price, it is not a buy. But let's start with the sell. He has been reducing, Buffett or somebody else at Berkshire, Apple position again in this quarter after already selling more than 50%. Well, if you look at Apple, the P ratio is 36. I think that it has been pushed higher because it is the biggest market capitalization there, thus automatically ETFs, index funds are buying more and more of it, but also because of buybacks. If we take a look at Apple's revenue over the last few years, it has been stagnant. Similarly, net income has also been stagnant, just below 100 billion. Now, everything is great there. However, capital expenditures compared to the 100 billion of Amazon and things like that, Google, Microsoft, is ridiculous, which means that Apple doesn't really target huge growth here. They're just milking what is there with the iPhones, etc. The ecosystem is not growing as fast, and they are spending all the money on repurchases, and that is something Warren Buffett has been warning us over the last 7-8 yearly letters, especially I think targeting Apple, saying how buybacks at high prices are practically stupid. And in my opinion, this is the main reason Warren Buffett is selling Apple, because Apple shifted to pushing the share price as high as possible through buybacks, of course, to reward management, ownership, CEOs, whatever, instead of focusing on continuing the growth trajectory, which has been Apple's focus also when Warren Buffett bought. So that shift in strategy is why Warren Buffett has been reducing Apple, likely because of the stake there and the size, in a controlled environment and deal with Apple itself. Because, as we said already, Apple is not growing as fast as one might expect. It's still growing a bit, but no recession yet or other. Let's go to some other businesses. Addition was Lennar Corporation, home builder, P ratio 11. Of course, when Berkshire or somebody at Berkshire bought, the stock price was much lower, even cheaper, P ratio 7. Now there has already been a rebound. As one of the home builders that we discussed already is also David Einhorn's Green Brick stock that we will put in the link in the description below if you want more information about that. But that is also still at a P ratio of 10, so very cheap situation for home builders there. If we look a little bit at the company, everything looks stable. They are warning of softer markets, but still giving good net earnings and maybe not as disastrous forecasts as other expected, so softer market conditions, but still going on there strong, and that is why the stock also, perhaps because of Berkshire's buy, rebounded already significantly. Revenues are still stable, good earnings, operating earnings 728 million. So you get to that P ratio of 10, 11. However, the risk always with these home builders is a crash, a freezing of the markets, then makes things very ugly. Of course, if they have the backing of Berkshire, then they can survive everything. However, that is the risk. Likely someone at Berkshire have been placing the bet that the panic of April was too big and they already made that return there. However, another significant bet that has been placed that might not be somebody else but actually Warren Buffett is United Health, and that has been a stock that you requested a lot over the last months. If we look at United Health, there was the crash, a little bit rebounded, but we are still far from where it was just a while ago. They have reported results, they have re-established the outlook that is leading to the small rebound there. So revenue outlook, earnings outlook of 14.65 per share, 16 adjusted. And let's say a return to normality for just a while. They expect to return to growth in 2026. They have reintroduced the quarterly dividend, which is now a yield of 2.8% on the current price if they just keep on doing it. Over the years, United Health has grown for an insurance business really staggeringly with double-digit growth rates. Then we have seen now again a slowdown, but still growing. Net income also growing 3x in the good times. Then we had that hit and they are doing some buybacks, okay. However, the reward here is that they return to the growth of the previous 2-3 years. If that happens, the P ratio goes from 20 to 30, market P ratio 40, if the growth returns to double digit, and that's a double in the stock price like this. The issues are continuation in that healthcare situation, the issues, scrutiny, government scrutiny, things like that, maybe new laws. If in the next election that is a topic, that might put pressure downward. However, we must also take into account Berkshire perspective here as a big player in the environment. I've made this video 3 years ago discussing how Berkshire, Warren Buffett, sells 9 out of the 10 stocks they buy. So they buy to see how does it feel to own them, likely get into contact to management, see whether it is something to, let's say, buy and hold forever. Because if we look at the market capitalization of United Health, 285 billion. If we check Warren Buffett's cash pile, 347 billion, which means that Warren Buffett could now take over United Health if in the next holding rounds and owning quarters, it is something that might enhance the value of Berkshire forever. The P ratio on the guidance is 20, which is, okay, let's say not a cheap price, but a fair price. And from a current hour risk and reward perspective, we can see it go to 30 P ratio, you make 50%, perhaps 40, you make a double. If there are issues, costs, things like that, then maybe earnings will continue to go up and balance out on a decline in valuation. So I think the risk and reward here is positive. On the upside, you have a 2x possible for a minus 30-40% on negative things. So when it comes to strategy for your portfolio, keep in mind it can be volatile. There is perhaps, if Buffett likes and says, okay, we can go in and set the company straight, if the current management can set the company straight to have a feeling of fairness, because that is how Berkshire has been doing business, they might, let's say, have United Health as an elephant in their target and spend 300 billion, 400 billion on a takeover, which might make things very, very interesting for investors. This is the upside. On the downside, the P ratio of 20, likely they will grow this and that, maybe the litigations will not be as costly, which is something also Berkshire will see over time, and then the downside might be a little bit limited. So very interesting situation for Berkshire and United Healthcare. We go to our next position. We have Li Lu going into Pinduoduo, which is the aggressive e-commerce retailer from China. If you want to compare it with Alibaba, check my quadrant video, the links again in the description below, and then you can see which one might better fit you from an investing perspective. Pinduoduo has been, let's say, volatile over the last few years, but if you look at the P ratio 13, we will adjust a little bit for that just by looking at the last quarter results. The revenues increase 7%, which is not that great. However, operating profits decrease of 21% is something very significant because Pinduoduo is operating in a very competitive environment of the global e-commerce, but also China e-commerce, and their target has always been low price, which means they need to really invest and lower those prices, and that's what they are saying. In the past quarter, we continued to invest in merchant support activities. And also, as we are discussing one video of Brandon van der Kolk, hi Brandon, long time no see, from New Money, this is also what he said. Pinduoduo is down because they have had to increase significantly the investments into merchants, into just all those advertisements and competing around globally. Especially when you compete at low prices, then it can get very ugly if others also start competing on those levels. And this is the explanation there. Total cost of revenues increased 36%, which is something staggering. Another question is always, why are they having 60 billion in cash, short-term investment, cash and cash equivalents on the balance sheet? Why don't they give a 30 billion dividend or something? What is the management trying to do there with their cash is always the question, and you never know whether they will be siphoning out money a little bit over time, because that is something that has happened often with Chinese investments. If we look at the conference call, that is more spending on the merchant support program just to fend off competition. There was this good questions from Alicia Yap from Citi. So how does the management think about the next phase of global business? And also on the local question, navigating these competitive dynamics. If we go to the competitive dynamics, well, everyone is investing heavily in new business models, which is a negative when you compete on cheapness of price. On the global business, they say they are just in the early stages and plenty of room for improvement. However, if I ask my very smart assistant, ChatGPT, the key factor is that Temu's business global is unsustainable and especially unprofitable at scale. They are losing $30 per order potentially, and they are still growing, trying to get that, let's say, market penetration. However, they are losing money on marketing, and it is hard that given the competition and also a reason why others aren't entering the space so aggressively, like Alibaba, Lazada, they are slowly growing, then you see that high losses per order and heavy spend on growth and marketing. This is very risky, and we'll see how it goes. However, Li Lu has bought a significant buy, almost 20% of the portfolio. So perhaps it was just a tariff panic volatility buy that allowed him to buy very low. The stock is already up 40%. So unfortunately, these were the times where many of the big boys entered. We also bought something, but that's now already a little bit different. If we continue on Brandon's video, Bill Ackman, I'll also put the Brandon's video just for reference and information. Bill Ackman has bought Amazon, but already there he bought in, the stock is already significantly higher. And we also discussed in the quadrant video how if you buy these great businesses at temporary panics, you can get great returns. And this is also what Bill Ackman says, that he was able to buy Amazon and react quickly and build a position at deeply discounted valuation from a business of its quality during the April volatility. However, we must also update a little bit on Uber Technologies, the largest part of Bill Ackman's portfolio, and the stock is not yet that high when it comes to fundamentals and Bill Ackman's plan. If we look at last letter to shareholders, Uber Technologies, Ekman still believes the stock is mispriced due to misplaced concerns, perceived long-term threats from autonomous vehicles. Actually, this could be a benefit to Uber, according to Bill Ackman, because all these players are better to partner with Uber's scale and therefore maximizing the unit economics of their vehicles. So, small potential entrants lack the resources, capabilities, and network density to adapt a standalone rideshare service. In the meantime, Uber is growing on all fronts, bookings. As everything is scaling up, profitability is also growing. However, there are some asset sales and they have started spending all the money on the buybacks, which then also puts pressure on current stock prices. So buybacks means there is, let's say, a floor on that, however, also that the stock price might go up significantly. The key is, when it comes to buying Uber, we have likely a monopoly already built such scale that everybody is talking about taking an Uber now, not a cab or something else, and therefore they might be building a moat. Therefore we might be talking about long-term positions. And when it comes to portfolio positioning, of course, this is not for me because I'm an extreme value investor. However, when it comes to portfolio positioning, 20% that Bill Ackman has put is significant. Perhaps 15% is what he bought initially, now the stock is higher. However, you can also think of it as volatility. You buy one stage, if it goes lower, you buy more, and then when it rebounds because of its position, you make some money at first and then see how much you want to hold for longer. However, if I'm looking at EBITDA and growth, of course, when this grows at 35%, everything is cheap, and even if the P ratio currently is around 30, 35% growth, according to Peter Lynch and growth stocks, if a business is growing faster than its P ratio, it is still a positive cheap buy. Then we have Seth Klarman. He has been increasing his Google position. We have already discussed Google. However, again, he has been increasing it at that periods in volatility. The situation with Google is that the numbers are still great, everything looks great. However, the fear is, again, ChatGPT and all the other AI providers that might in the future disrupt Google. For now, it's not happening. However, as the stock is already up significantly, the risk is higher, the return is mathematically lower. The other video apart from Brandon's was Michael Burry is buying big, and this is something we have to really be careful when it comes to comparing our investments and the big boys. Michael Burry sold everything and actually went short in Q1 2025, anticipating the tariff impact and all the Liberation Day volatility, so he likely made money there again. Then Q2, he likely again bought all those things back on the cheap, but how? With call options, not really positions except for these guys, but mostly again options, options, options. So Michael Burry is timing these things, is playing on the volatility, is playing on the trends, is reading the market. And United Health, we already discussed. Regeneron, I'm not a specialist on pharmaceuticals, so I can't help you there much. Meta, likely again a rebound on things. And let's discuss Lululemon that we discussed in a video just a few days ago. However, this happened since, and as discussed in the risk section, there was more likelihood of negative situations, and now the stock is even lower. If we look at the management view, revenue fell short, and they say already we have become too predictable within our casual offerings, missed opportunities, create new trends. But that's exactly what I always discuss with fashion. You always need new trends, but people get bored, they go to something else. And that is the risk. Therefore, I'm sticking to I'm not betting on these fashion. It can boom, it can go bust. too risk, not a value investment. And these not gaining the new trends, they have lowering their guidance, softness and tariff headwinds. This is also a big red flag because the management was just selling hope a quarter ago and now they are lowering it. So lower EPS for the year, as they said, $14–15 maybe, and now they are lowering to 12, and you never know whether they will be lowering it again. Analysts have downgraded the company, but look at these downgrades from 300 just 2 days ago. Now that the situation is terrible, now they are downgraded. Why they didn't downgrade it when the price was high? Again, that's normal how analysts live. 360 to 200, that's crazy. The thing is that it is impossible to see because there is no margin of safety. Another buy is Estee Lauder. Of course, Burry with call options or positioning here, they took advantage already of the rebound. However, we are still significantly down from the pandemic highs. But if you look at the long-term chart, maybe we are still on the long-term trend. We've discussed this a few months ago, and again, like other companies, the sector is in trouble. However, okay, you can bet on these rebounds and make almost 100%, which is crazy. But if we look at the financials, new leadership, maybe sales and growth, organic sales, someone is expecting positive operating margins, and then betting on that stock to return. There are still some cash flows, however, significantly decreased for the year, so just to 1.2 billion. Now we are at the price to cash flow of 30 something, capital expenditures. Okay, when you deduct, there is not much more money left, and they are also lowering a little bit the dividends. Now, what would Buffett say about all these bets that they are making, the big boys? If we go to 1989 letter to shareholders, Warren Buffett shared his criteria to buy stocks. And here we go. Consistent earning power, not projections, not hope, consistent demonstrated earning power. No turnaround situation. So all these fashion companies are a no-go for Warren Buffett. Management in place, we can't supply it, so he wants not new management, which he says he needs good management, and that is perhaps why he's testing United Healthcare that has demonstrated consistent earning power over time, and now if the new management knows what they are doing and puts the company in a good place, perhaps Warren Buffett, if the price is still good, might take the big elephant down. So these bets, yes, you can make 50%, but you can also lose your shirt if something like this happens. Now, a good question is, Sven, if I gave you 1 million and you can only invest in the stocks we discussed, what would you do? Okay, Apple, Buffett selling, that is too risky. Estee Lauder, crazy fashion, consumer preferences, too risky. This also Lululemon, too risky. Now, Pinduoduo, that growth, you can put something perhaps a little bit too risky, but Li Lu is extremely convinced. So perhaps in the next quarter, if the stock price is cheaper and Li Lu is still holding his position, that could be something interesting. United Health Group, perhaps too pessimistic market reaction. The market always overshoots on the good and the bad. Therefore, this might be something interesting. Google, the stock is already up, but perhaps we could put something. And Uber, if it is a monopoly, we can discuss. 20% here of the million if I had to spend it, 20% here, 10% here in Pinduoduo, and 10% in Google. I have spent then 60%. I would put then the rest in treasuries and wait if I need to focus on these companies, perhaps to get all these at a second buy cheaper. Personally, I would not really buy. I prefer, for example, what I discussed, companies like in the quadrant video, so check that. If you like this analysis, the risk and reward perspective, subscribe, and I'll see you in the next video.